Hello, it's Thursday, 2 o'clock, and I am here to educate Accounting 230, course number 42139. And according to the module and what we've done so far, we are on to chapter 7. We recently went through chapter 6, which introduced you to the details of how you handle cash, accounts receivable, bad debt expense, returns and allowances, things like that. We learned how to go from gross sales to net sales. That's the beginning of a longer income statement that we're going to be learning to prepare, okay? So I'm going to start us off with a PowerPoint here, and then I'm going to interrupt it to go to another PowerPoint that I think clears things up on a particular area a bit better. So let's see here. I want to make this my size. Off we go. Chapter 7. Here we're going below gross. We're going to another component, rather, of gross margin, which is cost of goods sold. Cost of goods sold. Net sales minus cost of goods sold gives us something called gross margin. That's the amount of income we generate between what we paid for the merchandise and what we sold it for. In other words, you can think of it as gross margin as income before operating expenses. You subtract operating expenses, you get net operating income. So they're showing us an income statement here. Not too hard. Harley Davidson, net sales $5.5 million first year minus the cost of goods sold. Gross profit. Who knew, huh? Gross profit. And in this chapter, we need to understand that the cost of goods sold might not just be the purchasing price, okay? It might not be just what you paid for the goods. For example, if you bought a truckload of inventory from the East Coast coming from New Jersey, you might have had to pay another $5,000 to the truck driver to get it across the country. Those two costs go into the price or the cost of the unit. Don't worry about raw materials, direct labor, overhead. This is 240 material. We don't care about that right now. We're strictly merchandisers here. And the cost principle requires, like I just said, you paid $100,000 for some goods, it cost you $5,000 to bring it across the country. And then when it arrived, you had to carefully inspect it. That cost you another $5,000, so up to $110,000. And then you had to do something to prepare these goods. Maybe you had to specially wrap them or something. All of those are the costs of getting it into your finished goods inventory, okay? Or your merchandise inventory. Let's not call it finished goods until you get to 240, your merchandise inventory. So inventory cost, incidental costs such as inspection and prep costs do not have to be assigned if they're not material. So a lot of these can be expensed. I mean, if the freight cost was, $10 to get it across the street, you just forget about that. Expense it. Materiality. That's another GAAP principle, GAAP, materiality. The auditors come in and they say, how much is your interest expense on your bonds? And they sit down and they do a calculation. And your number was $1 million and their number was $998,000. They would probably say that's not material enough to worry about. They might want you to adjust it, but it's not a devastating thing, huh? Please, please, please look at this grid here. Have this in your head because this is the basis of what we're going to do in much of this chapter, huh? Total goods available for sale. The beginning inventory plus your purchases. Well, that makes sense. We had a beginning inventory of 1,000 books. We purchased another 9,000 books. That gives us 10,000 books available for sale. That's the most we could have sold. So at the end of the month, we're going to go over some different costing methods that assigns the cost of goods available to either the ending inventory or to the goods that have been sold. Okay, so on the bottom here, I'm seeing beginning inventory plus purchases gives us cost of goods available for sale. Now we went out and we counted the ending inventory. Well, that cost of goods available for sale, those goods, those 10,000 books I was talking about, they are either still in the inventory or we sold them. And to the extent it was in the inventory, we costed the inventory at 35, which makes our cost of goods sold $60,000. Okay. Please be very comfortable with the simple little formula. The goods available for sale is your history. It's always going to be the same for no matter what cost method you're using. You're always going to start at the beginning inventory plus the purchases, huh? So let's see what we have here. We can talk a little bit about the difference between the perpetual and periodic system. We're still going around with the periodic system right now in the class. This means that we do not record the reduction of the inventory nor the related cost of goods sold at the time of the sale. We only record the debit to cash or accounts receivable and the credit to sales. We don't keep up-to-date records of the inventory under this system. If this was our store, and we got a call from a customer, and the customer said, how many of these shirts do you have in stock right now? We are not going to know because we don't have a perpetual inventory system. You're going to have to say to that person, hold on, please, let me go back and check. And by the time you get back to her, maybe she's hung up and gone elsewhere. So that's the periodic method. The sales require one entry to record the sale. That's the debit to AR, credit sales. But the cost of goods sold is calculated at the end of the period using the formula we saw on the prior page. Beginning inventory plus purchases, that's $95,000 worth of goods. That's the most we can sell. Hopefully we sell it, these 95,000, we sell it for $1 million, but the cost is 95,000 to be split between the ending inventory and the cost of goods sold under different methods. Perpetual, get into this a little more later, but a perpetual system, you're writing the same entry here. You're writing the sale, you're doing the sales entry. Perpetual, you sold it, debit, AR, credit, sales again, but you're also recognizing the cost of that goods was, say, $5. So you're debiting cost of goods sold and you're crediting the inventory, okay? Here, you're not working with a purchases account. Purchases is a cost. Here, you're going to work with an inventory, an asset, okay? Now we're going to go through 4 different methods. And here's where I might bounce back to another textbook I found a little more easy, I think, at least for me. 4 costing methods: specific ID, first in, first out, last in, first out, weighted average. FIFO, first in, first out. We are going to pretend for costing purposes that we sold the oldest inventory first. So if we had inventory, if we had 100 at the beginning of the month, and we had a purchase of 500, and we sold 60, we are going to assume that that 60 came from the oldest or beginning inventory. Last in, first out would be the opposite. We're pretending that we never sold the first item we ever put on the shelf. Now, clearly, neither of these methods are going to mimic the physical movement of the goods. That's not the point of this. These are 4 different choices companies have, and we'll talk a little bit about why you would choose one over the other and when you have to use one or the other. Specific identification, that's for big ticket items. Big ticket items. When I bought my brand new Maserati the other day, when I went into the dealership and I said, I want to buy the Maserati, I drove it for a few miles, tested it out, sounded good, brought it back. He didn't hand me a bunch of car keys and say, take any of the red Maseratis you want off the lot. No, under specific ID, the company has to have something with a serial number, in this case, a VIN number. the chassis, what kind of engine was in that car. They need to know exactly where that car is if they need to recall it, or there's an accident, or they're sued for some reason. Specific ID. Airplane parts is a good one, huh? Weighted average is easy. It's just going to be taking this column here that's called goods available for sale and dividing it out. You get an average cost per unit, okay? So let's start looking at a few of these. When the units are sold, the specific cost is added to the cost of goods sold. And you notice you have three high-level items here, huh? There's a car, there's a diamond, and there's a house. I grew up back in New Jersey in what they called a development. In those days, there was houses built after World War II that were cheap, and they were all pretty much the same layout. There wasn't much difference between them. And my father, like so much many of his generation, he was a World War II veteran. And with the GI Bill of Rights, he was able to afford one of these development type houses. My point is, he didn't get the keys to any house in the development, although they looked exactly the same. He had his very specific address. That house had to be traced back to my father, which there's a big problem, huh? The choice of an inventory costing method is not based on the physical movement of the goods, only specific ID. LIFO certainly doesn't. You ever go up to Mesa Produce next to on the Cliff Drive there? Mesa Produce, believe it or not, they use the LIFO, last in, first out. That means that the first bunch of bananas they put out for sale back in 1953 is still sitting there. Now, do you really think it's sitting there? No, but we are pretending that for purposes of inventory costing. FIFO, this might track the physical goods, but there's no guarantee, and it's not intended to imply that is the case. Weighted average is just a mishmash. Average cost method. Whoa, this is a tough one. When a unit is sold, you just assign the average cost to the cost of goods sold in the inventory. So what we're talking about here is horizontally, and I say horizontally for a reason, which you'll see shortly, the cost of goods available, the dollars, divided by the units available, will give you an average cost, okay? We're going to go back to each of these methods with my other set of slides that I like here. First in, first out. First in, first out. The oldest goods we assume are being sold first. And by the way, I'm sick of people telling me I look like that guy with the what do you call it, the telescope there, all right? I don't want to hear that from anybody. First in, first out. Last in. The oldest costs go out last. And let's look at this another way, and then we got a handout here. Now, this is the handout I don't particularly like. So with that in mind, give me 1 second or two here to quickly share another screen. Huh? Okay, this is from a different course. Inventory cost components, huh? Proper cost must be assigned to the inventory, like we just said. And that includes delivery cost, insurance, storage fees. If you have to knock down a wall in the building to get it in, you could justify that being part of the cost. So here they're introducing us to the same methods. And these methods are good, either periodic or perpetual. We don't have to worry about that. Here we go, specific ID. You got to have items that are pretty physically different from each other. A diamond, a house, a car. And they should have a serial number, something you're going to be able to trace them. How else are you going to do it? Cost is determined from the invoice. And these are the high ticket items with lower volume, okay? So let's take a look here. Inventory costing example. Here is what you're going to have. Here is what you are going to have before you cost out the inventory. So let's look at this. At the beginning of the period, we had 40 units in the inventory. That's first in. The next item that came in was this first purchase, then a second and a third purchase. So the 40, guess what? That's first in. The 70, that's first out, okay? Last out, last in, Jesus Christ. We start again. The 40 is first in, first out. Here, last in, first out, okay? So let's have a little fun now doing a little calculation. We add these units up. That's 250 available for sale. They've either been sold or we still have them. At the end of the month, we counted 50, and that leaves us with a unit sold 200. So now how are we going to divvy out that $16,500 number right there, okay? Ooh, we're going to start with the specific ID method. Specific ID. Well, let's see here. They're telling us that we sold the 200 printers. 30 came from the beginning, 50 from the first purchase, and 60 from the second and 60 from the third purchase, huh? So let's just go back and look. 30, 50, 60, 60. So under this method, it looks like we pulled inventory from all four layers. 30, 50, 60, 60. We sold 30 from the 40 you see here. We sold another amount from the 60 and the 80 and the 70. This thing's playing a little, give me a little hard time here. Hold on. All right. So we had layers of 30, 50, 60, 60. 30, that means there's 10 left in this inventory, 10 left here, 20 here, and 10 here. Let's go one more step. 30, 50, 60, 60. Now take a look at these grids here. We're going to be going over these for the next 15 minutes or so, okay? Cost of goods sold, specific ID. They told us that the 200 we sold, 30 came from the beginning inventory, 50 came from this layer, and the next two layers, 60, 60. You multiply them out. Our cost of goods sold is $13,210. Not too hard. Okay. This layer, we had purchased 40. 40. We sold 30, and that leaves us with 10. Here, we bought 60. We sold 50. That leaves us with 10. And here, we sold 40 out of this layer. And it looks like we sold 50 out of that layer. They gave us these numbers. So we have the ending inventory of 50. 10 left over from this layer, 10 from this layer, and 20 and 10 of the remaining two layers. So take a look at it. Units times the unit price gives you the total cost of goods sold. Now, here's a little trick. We know that the cost of goods available was $16,500, right? We know that. Well, if we take the ending inventory balance, which is $32.90, and subtract it from the $16,500, we have the cost of goods sold. The point being, cost of goods available, I say it another way. Yeah, cost of goods available minus the ending inventory gives you the cost of goods sold. Right here. The cost of goods available minus cost of goods sold gives you the ending inventory, huh? Why do I point that out? It's a shortcut. It's a shortcut. And on the exam, you might get a problem where they have 10,000 in the beginning inventory, then they bought 20,000 more, and then they bought another 20, and maybe another 50,000. And they want you to compute the cost of goods sold. And then they're telling you there's only 1,000 left in the inventory. It's a lot easier to work with the 1,000, isn't it? Get the inventory value. And once you have that, all you need to do is subtract to get the cost of goods sold. So I don't think this is too tricky at this point. Let's look at FIFO. FIFO. Here, we're assuming that the first goods purchased were the first goods sold. First in, first out, the late stuff remains in the inventory. And they're just making a general comment. Whenever possible, a business will attempt to sell the older goods first. Yeah, in most cases, I guess. Not always, though. You ever go down to the Ace Hardware guy on Gutierrez, and you see that big metal barrel full of nails? Well, they filled that pail up back in 1960. And when they get down to about 1/10 of capacity, they just pour new nails on top of those old ones. So those old ones have been sitting there forever. But we can pretend they were first out. First in, first out. So let's look at FIFO. FIFO. Here, we don't have to go back and forth and find out when things were sold or whatever. How many were sold? We agree 200 were sold, right? We all agree. I need a show of hands. There we go. Thank you. First in, first out. What was first in? 40. Well, we have to get up to 200. We sold all 40 of those. So there's nothing left in the inventory. We sold all 60 of those because that's the next oldest. That removes the inventory and gives us 100. 40 and 60 is 100. 80, we got rid of that entire layer. That gets us up to 180. And we only need 20 out of this layer to come up to 200. So that layer was 70. And now our ending inventory is 50 at that cost, 50 times 68, 3,400. We multiply these out and we come up with the cost of goods sold. So I call these layers. A lot of textbooks call them layers. That's what we call them at work. The different layers. Your oldest layer, FIFO, the beginning inventory here, is the first items you sold. So when you come up with these two numbers, you have your two figures, 13,100 or 3,400 for the ending inventory. And remember, cost of goods available for sale minus cost of goods sold equals your ending inventory. Cost of goods available for sale minus ending inventory equals cost of goods sold. So they had 50 left in the inventory. Well, you sold 200 and you only had 250 available. So it would have been pretty easy just to go 50 times 68. And then you got both numbers that quickly. Okay. Look for the smaller number. Do either the cost of goods sold or what's in the ending inventory. Weighted average. This is pretty easy, my friends. Weighted average. You're going to take this line horizontally. I'm using the word horizontally for a reason. The total available divided by the total units gives you $66 per unit. And that's all you need. 66 times 50 in the ending inventory and 66 times 200. The reason I said horizontal is one mistake that students make, and it's an easy one to make, and it can be done if you're thinking a little bit too quickly. Okay, I got to get the average price. And they say to themselves, well, I'll add 62, 65, 67, 68 and divide by 4. Yeah, that gives you an average. It gives you an average that is worthless. You're not going to get the same $66. You're going to get a number that could be considerably different, okay? Horizontal, 16.5 divided by 250. You don't add unit prices. I never heard of anybody adding unit prices down to get an average, okay? The only way that would work is if the units were all the same, okay? Pretty obvious to point out, but that mistake gets made all the time. So here we go. Our cost of goods sold was 66 times 200, ending inventory 50 times 66. One of the advantages of the weighted average method is its simplicity. Last in, first out. Now we're selling the new stuff first. The new stuff first. Mesa Produce just got a load of grapes in. Those are the ones we're selling today, right now, according to LIFO. Okay. assumes the sales in the period were made from the most recently purchased goods. And they want to justify it. Physical movement of the goods is actually sometimes some businesses last in, first out. I'm not sure I could think of any, to be honest with you. But that's what they're saying. And it matches the most current cost of items purchased against the current sales revenue. All right, that's a good thing, I suppose. And it results in lower income and therefore lower income taxes. And we're going to talk a lot about that in a few minutes. LIFO. LIFO. Okay. Under LIFO, which ones did we sell first? We sold 70 from here, plus 80 is 150, plus 50 out of the first purchase of 60. 70 times 68, 80 times 67, 50 times 65. There is your cost of goods sold. We know that the cost of goods available is the same for all methods. So 16.5 minus the 31.30 gives you 13.370. You can just subtract it to get the 31.30. Or keep practicing. We had 60 here, so we know we have 10 left, and we never touched the first layer of 40. It multiplies out just like that, okay? So that's a look at the inventory costing methods, okay? Inventory costing methods. Now, let me go back to our textbook here, please. Give me just one moment. I like that better than this presentation with the old guy with the cane and the babies. I don't know. Just okay. Advantages of methods, okay? I'm going to preface this by saying everything we do in this course, let's assume it's a normal, healthy economic paradigm of rising prices. You want there to be some inflation in an economy to grow it. You don't want runaway inflation like when I was in college, where interest rates were 20% on a savings account, for Pete's sake. But inflation was roaring back then. That's too much. In a decent, normal, healthy economy, you do want to have prices going up a little bit all the time. You do want people getting raises all the time. If you're in a period of what's called a deflation, that's the word I was looking for, deflation, that's the worst of all worlds. You go to work every week and you're going to get your pay cut every week. Prices are coming down, but that means the people selling that product are making less money. That's not how an economy grows. Japan fell into that trap back in the 80s and 90s, and they're still kind of getting the kinks out, okay? So we're only talking rising prices. And the reason I emphasize that is if you understand these impacts with a normal, healthy, slightly inflated economy, all of the assumptions you're going to learn here would just be the opposite for deflation. So I'm a glass half filled kind of guy. We're not going to talk about the worst world of all kind, deflation. I don't even think in American history we've had a real period of deflation. I'd like to talk to somebody about that or read some more about that. Inflation has killed us, though. Ooh, big time. Financial statement effects of costing method. Oh, they're giving us this claptrap. It better matches with the current cost. Yeah, that's right. Advantages of the methods. You notice they don't show you the specific ID. The reason is there's no advantage to gain or lose because you have to use that method. The specific ID method, you must use it. You don't have a choice. These are the ones where you have a choice. Well, first in, first out, your ending inventory is going to be close to the current cost. But the cost of goods sold is going to be here more like the current cost. Weighted average smooths out the differences a little bit. Choice of inventory methods, okay? choice of inventory methods. Hold on, let me turn this stupid thing off. That's my bad. Sorry about the interruption. Turn that thing off completely. Manager's choice of methods. Well, you were gonna get different net incomes from each of the four methods. Yeah, different methods. So you might prefer to report higher earnings on your income statement. This might be a company that's just starting out and they want to show a big splash. Tesla announces record earnings of $6 billion. Another company might prefer to pay the least amount of taxes allowed by law as late as possible. So Tesla might choose FIFO, which is going to give them a higher income than LIFO. So if Tesla had 6 million, whatever it was I said, is their taxable earnings, these guys might have only had, say, 5.5 million, but they don't pay taxes on that 500,000 difference. LIFO conformity rule: if last in, first out is used on the income tax return, it must also be used to calculate the inventory and cost of goods sold. We don't go into that really in this chapter. I'll speak to Cornelia and double check that, but that's been the case as far as I've been here. I would really urge all of you, I mean, all of you are some kind of business or economics or accounting major. I would really urge you to take Professor Barbara Aue's tax class, where you'll really learn these types of things. Terrific class. And a friend of mine, he's a CPA at a pretty big firm, and he told me something that surprised me. He said when they hire accounting people, accounting graduates, if you will, from UCSB or any other place, UCLA or whatever, first thing they do is they get sent to Barbara's tax course. They think so highly of it. LIFO and international, whoa, we're not going to talk about that. No way. Okay, we're getting toward the end of this chapter here. The end of the chapter. Ending inventory is reported at the lower of cost or market. Here is another gap principle of conservatism. The principle of conservatism tells us that you must recognize and record a loss as soon as you are aware of it, but you never record a gain on the increased value of an asset. You bought a piece of property in Santa Barbara for your business. You bought it on the beach here next to Hendry's Beach. You paid $50,000 for that property, 1960, just to pick a year. And now 60 years later, that property is probably worth 10 million. But on your financial statements, it's still carried at 50,000. And the reason is you cannot anticipate that gain. You can only record the gain, the income, when you do what? Yeah, when you sell it. So we're going to compare the cost that we paid for something versus what it's worth on the market today. And we're going to update our inventory to extend it by the lower of cost or market, okay? The company will recognize a holding loss in the current period rather than the period when they finally sell. This is the principal practice of conservatism. So this is not too terribly tough, as long as you understand what we're trying to do. Every month, when companies prepare financial statements, they must do this lower of cost or market review. It can be done line by line, like you see here, but more likely for a big company, you're allowed to aggregate similar items together. Perhaps men's t-shirts, men's dress shirts, something like that, rather than each individual one. Either way. So let's see what we have going here. We have an inventory of Pentium chips, 250. We paid $250 for these goods. So our inventory for that item is valued at $250,000. Would you agree? 1,000 times 250. We also have in our inventory 400 items at 100. So I guess that's another 8,000. Okay. 400 times 100, that's 40,000. So we have a total inventory right now of 250 plus 40, $290,000. I wish they extended it to be a little more clear, but this is our inventory right now, 250,000 plus 40. We have 290,000 now as our inventory value. Now, our salespeople are running into us, and you're the boss. I go running into you. I say, boss, these chips, how much did you pay for them? And you say, I tell you, I paid 250. I said, well, you were nuts because the prices come way down. The most we're ever going to get for this chip right now is only maybe $200. We have to recognize that $50 loss on whatever in the inventory. So we're going to take 200 times 1,000, and we're going to step on the 250, 200,000. Disk drives, we paid 100 for these, but we're selling them for 110, it looks like. So what's lower? The cost of the market. The cost is lower. That's what we want. That's what we hope to see. So nothing changed. That'll still be 40. So that $290,000 inventory must be written down by $50,000. 250 minus 200 is $50 per unit times 50. Not a hard calculation. And you're going to debit cost of goods sold and credit the inventory. The inventory has lost that value. Where I worked for a long time with Thomas and Betts, we called this cost of goods sold dash lower of cost of market. I think we called it cost of goods sold dash LCM. I think is how I set it up. Okay. So that's an important little thing to understand. I'm not going to go into LIFO liquidations, mainly because I can't pronounce it. So let's not worry about that. That would be another Barbara Owie thing. I do want to go back to the other slides, though, for just a brief moment, because these slides didn't really get into, I think I have a better presentation here. Here we go. Let's take a look at these numbers from the other course. Comparison of methods. Let's start with FIFO. FIFO, they sold the old, cheaper goods first, okay? So they came up with cost of goods sold of 13,100 and a profit of 49. FIFO. Let's compare that to LIFO, where of this cost of goods sold, they sold the more expensive items first, the latest stuff. So let's see what LIFO tells us. LIFO tells us that the cost of goods sold was higher. It's $270 higher, and thus the gross profit is $270 lower. So FIFO will always leave you with a higher income than LIFO, qualified by a paradigm and environment of rising prices. You want slightly rising prices all the time. That's the whole game with the Federal Reserve since 1913. The Federal Reserve, that's kind of what they're looking at all the time. They're trying to come up with the optimum inflation rate needed for what they call full employment. And that's the game that keeps going out of balance and requires constant attention. FIFO, higher profit, lower profit. So these are big companies, huh? So this is 4,900,000 minus the 630. That's $270,000. Well, at 30% tax rate, this company saved $81,000 in taxes. So cash-wise, you're better off with LIFO, unless you want to be like Tesla and you want to have a big press release. Tesla announces fantastic earnings, 4,000,009. I mean, most investors, people read financial statements and kind of figure that out, but it does draw attention to the business, okay? I don't think you're going to be surprised to see that weighted average is somewhere in between. It would have to be. It would have to be. So 49, 48, 46. And then specific ID could be anything. It just depends what you sold. For example, if we sold if everybody bought the new stuff, then this would be higher than these other three probably, okay? Because it would be a mix of the oldest, okay? So these are your four methods. They yield four different net incomes, and for different reasons. FIFO, you're selling the cheaper stuff first, lower cost of sales. LIFO, you're selling the expensive stuff first, higher cost of sales. Weighted average, right in between. That's why they call it a weighted average. And specific ID, this is the one where there's really no thinking to do. And in our textbook, in this class, what I really don't like is if you look at the problems in the back where they're giving you specific ID, I get the sense the publisher said, well, this is too easy. If we tell the students that one came from here and five came from there, well, it's too easy. And how do they try to make you think? Through the English language. They'll say something like 2/5 of the sales came from 1/3 of the beginning inventory, and 4/5 and 1/3 more came from any of you baseball fans out there. It's like Casey Stengel. Look up Casey Stengel on Google one of these days and listen to him try to explain something. They just try to fool you with language. And it kind of annoys me because as long as I've been teaching and tutoring and stuff, I always screw that up when I'm trying to read those things. 2/5 of the first layer represents 3/5 of half the sales. Perpetual inventory system. Okay. So I think that brings us to an end here. You've been a great audience. And I hope that this has gone through okay for you. And we will see you next week. Okay. Bye-bye.